If you have ever looked into the business world, you may have seen a set of financial statements and wondered what exactly they are, or how to understand them. You may have even asked yourself, why do we need financial statements, or why are they important? Why are they so complicated? In this series of videos, we will address basic concepts of the three major statements and formulate a simplistic example of how they are created. First, let's step back in time. 1929, the Great Depression in America was a time of financial devastation for many people. One contributing factor to the collapse of the financial market was no standard of reporting for businesses. This meant that all businesses could choose almost any method they could think of to report their financials. Most of the time, this created an inaccurate report about the health of companies, leading to banks and investors losing fortunes. In response, the government stepped in with the assistance of accounting groups to create a system of standards for ethical and accurate reporting. Thus, the Generally Accepted Accounting Principles, or GAAP, was created by 1936 by the American Institute of Accountants. Today, the main accounting board that determines GAAP is the Financial Accounting Standards Board, commonly referred to as FASB. Their job is to maintain and continuously update GAAP standards. The purpose of financial statements is to provide an accurate picture of how a business is doing. They help determine where cash is going and if a business is profitable. Internal users, most commonly management, use statements to make decisions and assess company performance. External users of a company also need financial statements. Banks and investors both rely on financial statements to see if the company could pay them back or give them a return. The three major financial statements that are required under GAAP are the income statement, balance sheet, and a statement of cash flows. As we further discuss these financial statements, some things to keep in mind. These statements rely on each other to be created. For example, the net income, derived from the income statement, is used to calculate retained earnings, which is reported on the balance sheet. The balance sheet and net income are then used in completing the statement of cash flows. Some of these accounts we will discuss may be called different things depending on the type of business entity or company preference. Even if they are called something different, they usually mean something similar. For example, in a corporation, the equity section is called stockholders' equity, but in an LLC, it is members' equity.